All right, time to look at policy loans, but answer the question or a couple questions that come up quite a bit by individuals that have large whole life insurance policies or are considering large whole life insurance policies or their advisors, which I love bringing up these questions because not everyone is paying in several $100,000 per year or $1 million per year into a whole life insurance policy and has an advisor that can ask the right questions for them. But if we know what questions are being asked, and then we can ask that or have someone provide it to us, I love that kind of stuff. So that's exactly what we're going to do in this video, and then also provide answers to those questions. So questions we get sometimes here, particularly from people in this range, paying 6 figures to 7 figures per year into life insurance policies, cash value is the goal here, is as follows. How much am I earning on the policy? And we hit on this in earlier videos. That's the internal rate of return, the net growth rate. And to take it a step further there, what's the actual internal rate of return if I want to look at a rate? And then what's the actual dollar amount too? That's something that people like to see up front because it provides more transparency. I'll show you exactly what I mean in a minute. And then what's the actual cost to borrow? Doing the exact same thing here, what's the actual dollar amount? And then what's the actual loan interest rate that's going to the insurance company? This way I can see, is it from a dollar perspective in my best interest or not? And if it's not, that's okay, because I'd much rather know about that upfront before dedicating money to a policy as opposed to finding out after the fact. The purpose here is not to win a sale. The purpose here is to provide the education upfront. And if you feel it is a fit, then yes, you can move forward and the relationship will be great over the years. However, if you feel like you were sold or tricked, that's typically where people get upset. So let's answer these questions. We will lead off with the example we looked at in the past 2 videos, which is the loan model. Here we go. This is the simplified version that we started with. We've got $100K per year going in for 5 years. We've got the growth example on the left, then the loan and paying it in full on the right. There's my $300,000 loan. There's the impact of the loan, cash value, my equity decreases. My death benefit is collateralized, dollar for dollar. We've got the loan interest each year. So here's the loan interest. Here's the payment out of pocket. Purple is what you're actually paying. And then loan principal, same thing here. So you're paying the loan interest as it comes due. And then also the $30,000 loan payment. And just quick side note here, we did increase that loan rate to a rate higher than it actually is at the time of shooting this video. The rate for this particular product is 4.65%. So we increased it by 100 basis points to make things more conservative. But here, what do we see? In year 17, everything's paid back, and what do you notice? Cash value and death benefit is fully restored to what it would have been as if you never touched it in the first place. Okay, so this is just a simple loan model that demonstrates how policy loans work. Let's take it a step further though. Let's take a look at the rate first. So when I say rate, what I want to know here is what is the policy actually growing by, and then what am I paying in loan interest? And the first thing I want to address is the point of frustration that pops up with individuals, which is this. On my policy, I was told, Steve, that I'm earning a 6% dividend on my policy. So I'm earning 6%, and I can borrow against it at 5%. Even in this example where we increased the rate 5.65%, when you see that, so pretend you can't see anything on the bottom, just a dividend rate of 6% and a loan rate of 5.65%, what goes through your mind? Does that sound like a good deal? Yeah, it does. It's a positive spread. If I can put money into an insurance product, they're going to pay me 6% interest and only charge me 5.65, not 6% to borrow. Yes, I'll do it all day. The thing is, it doesn't work like that. Oh, how I wish it did, but it does not work like that. So looking at the growth example, it is true that this illustration assumes a dividend rate of 6% forever. However, the 6% is not what I'm earning. If I take a loan against the policy, the 5.65% is what I am paying to the insurance carrier. So in the first year, my cash value is what? I pay in $100,000, $84,231, which no matter how I slice that, my first year internal rate of return is what? Almost negative 16%, a little bit less. So I take a loss on my money in the first year, purely focusing on the cash value. Got a big death benefit, which is great. So if anything happens, then yeah, it pays off. But focusing on the cash value, take a loss without any loans. So if I take a loan in the first year, what happens? Not only do I have a negative hit on my money, but I've got a cost to borrow as well. It's almost as if I'm shooting myself in the foot in the first year. Now, as time passes, what happens? Continue to make the payments for 5 years, then pay in nothing after the 5th year in this example. There's my dividend rate, but we can almost scratch this column because it's not what my cash value is actually growing by. What I'd want to know if I'm using this policy, what's the annual internal rate of return? Typo there. And then what's the average internal rate of return? If I look at the annual, this one I like looking at, and this is just me personally, some people prefer the average. I like looking at the annual because if I take out a loan, let's say that it is in year 6 when I take out the loan, I'm just about 4.3% in that particular year. That's my net internal rate of return, how much the cash value actually grew by, 4.29. I took a loan, $300,000. The cost to borrow is 5.65%. So what that means is what? It costs me to borrow here. Now I can view it as a low-cost loan in this example, a cheaper loan, but 4.29, 5.65, it's just about a 1.35% cost. Now if we ran this at the actual loan rate right now at 4.65%, well, now it starts to look a little bit better, a lot better, I should say. But it's always good to look at the actual loan interest rate. As time passes, what do I see? Let's look at age 60. We can even look at 61. There's my annual internal rate of return. Shoots up a little bit there. It's because it's a 15-pay policy and the premium's no longer due there. That's why I see that shoot up in this particular example. We just ran a premium offset years 6 through 15. Another technical detail. But here, annual IRR, 4.9%. Cost to borrow, 5.65%. So now I can compare the actual cost to borrow compared to the annual internal rate of return. The thing to be aware of though, and if you're an agent, you're probably screaming about this right now or pointing it out, is the fact that this internal rate of return is still on the full cash value, while this cost to borrow is only on whatever the loan balance is. So it is true that I'm paying 5.65% on the loan, which is less than the total cash value. Then I've got the argument that it makes sense to earn 4% on $1 million. I'm only earning 4%. I've got a 5% cost to borrow, just for example, on $300,000. I still come out ahead because I'm earning a lesser interest rate, but on a larger dollar amount, if that makes sense. So it can make sense there. However, it depends how much I'm borrowing against the policy. That's what I want to look at here. So rates are good to look at. Another thing we can look at though is the actual dollar amount, just to break it down further. So in this example, what we've got is as follows. We don't have the internal rate of return. We've got the cash value growth. This is the annual cash value growth. And then we've got the total cash value gain. So instead of the annual internal rate of return, we've got the annual growth. And instead of the average internal rate of return, what was my overall gain? So here, 5 years in, $501,000 in cash value. I see how much my money is growing by each year. But I see by the 5th year in the total gain column, I've gained almost $1,300. Examples to the right, or example to the right. $300,000 loan. 5.65%. Loan interest, $16,950. I pay the loan interest. Far right isolates the total dollar amount I've paid in loan interest to the life insurance company. So there's two things I would direct your attention to in this example. One is the year I take out a loan, which is year 6, let's look at year 7, when the loan interest actually comes due, or I pay it. What did your cash value grow by in that year? Because you still receive this total amount of growth in this scenario, regardless if a loan's outstanding or not. 22,652 in light blue here. On the right, how much did you pay in loan interest this year? 16,950. You came out ahead. Bravo. And that'll continue to be the case in this particular example. What we would look at, though, is a more aggressive loan. Because what happens in this scenario, if I kick the loan up to $400,000 or $450,000, do you think that loan interest will still be less than the actual cash value gained? It won't until I pay some of it down. So that's the kind of stuff that's beneficial to see up front. I like the dollar amount. Some people like the rate. Depending on how much I actually borrow is important as well. But as I look at this, here's the total amount gained each year, and then here's the total amount paid each year. The second thing I wanted to look at was the total interest paid over time. So by the time that loan is paid, what did you pay in loan interest to the insurance company? $93,000 and change. And again, we ran this with a more aggressive rate, a bit higher than it actually is right now. So maybe we can find outside financing for a lower loan interest rate, or the insurance company has a lower fixed rate if I started my policy off with a fixed rate, that is. But now I get to see, okay, at the end of this loan term, my cash values are stored. That's fantastic. I paid $93,000 in interest. What did I earn on this? $311,000, almost $312,000. Because the full cash value that I'm still earning dividends on while paying loan interest only on the outstanding loan. Where this begins to get interesting and is not always in the policyholder's favor is a case where I increase the loan, I pay interest only, I don't pay it back. Those are the other kind of scenarios where we would just continue to build on. But my point here is really just making this transparent. So for example, if I'm working with someone putting $1 million in and their advisor asks for these kind of numbers, what we'll do is one, put them together and then also explain them at either in person, over a Zoom call, over a recording, making it very, very easy for the individual and the third-party advisor to get all of their questions answered. This way it's transparent, right? The education has to be first. Otherwise, things can go south, and that's where we see agents and advisors and clients fight with each other, which we do not want to fight with you. I will say that. That is not our intention. So I hope that this video helped in the last several videos on loans. Let us know. And if you are working with us, I hope you are enjoying the process. If you'd like to work with us, please let us know, and we'll talk to you soon. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.